Welcome to Dave's Market Explorer. This is your weekly market update covering the action that just closed and the structure that is now becoming clear for the weeks ahead. The past week in the S&P 500 and SPY delivered another chapter in a developing weekly pattern that we have been tracking. Price action remained volatile. SPY spent much of the week under pressure before a late recovery, but the more important message came from the weekly timeframe. SPY has now put in a series of weekly lower highs and lower lows since the early June peak near the all-time high area. That sequence continues. This week's low stands out. It ranks among the 3 lowest weekly lows recorded over the past 12 weeks. That is not noise. When a market that has been making progressive lower highs also begins printing some of its deepest weekly lows of the recent period, the character of the advance has changed. The weekly structure has shifted from a clean uptrend into a corrective phase. Adding weight to that view is the weekly MACD. It has turned negative. Momentum on the weekly chart has flipped. This is the kind of confirmation we look for when assessing whether a pullback is simply a pause or the start of something more meaningful. This development fits the broader expectation we have held for a summer into Q3 correction of some degree. On a weekly basis, that correction can now be said to have arrived. The market is no longer making the kind of higher highs and higher lows that defined the earlier part of the year. Instead, we are seeing the classic signatures of digestion and correction. Tom Lee of Fundstrat has been vocal about this possibility for some time. He has consistently maintained a constructive longer-term outlook, projecting the S&P 500 toward the 7,700 to 8,000 zone by year-end. At the same time, he has repeatedly flagged the risk of a meaningful test later in the summer or into the second half of the year. His recent commentary has pointed to a potential 15 to 20% correction as the kind of drawdown that would clear excesses before the next leg higher. The current weekly technical deterioration lines up with the timing of the tests he has been describing. Looking further into the weeks ahead, several additional factors deserve attention. Seasonality remains a headwind. August and September have historically been among the softer months for the S&P 500. That does not guarantee further downside, but it does mean the market is entering a period when buyers have often been less aggressive. Support levels will matter. The deeper lows printed earlier in the summer and the recent low near the 729 area on SPY create a zone that the market will likely retest or respect. A sustained break below those levels would open the door to a more classic correction measured from the June highs. Conversely, if price can stabilize and begin repairing the weekly structure, the correction may remain relatively contained. Breadth, interest rates, and residual geopolitical noise will continue to influence the path. The AI-driven leadership that powered much of the earlier advance has shown signs of rotation and fatigue at times. That does not end the secular theme, but it does suggest the easy upside from here may require a healthier foundation and better participation across the broader market. For the immediate weeks to come, the base case is continued corrective or consolidative action rather than a swift resumption of the prior uptrend. The weekly lower highs, lower lows, and negative MACD argue against an immediate V-shaped recovery. Corrections of this nature often take time to complete. They can produce sharp counter-trend rallies that feel like the worst is over, only to give way to further downside or sideways grinding. That said, the longer-term backdrop has not collapsed. The move into this correction has occurred from elevated levels after a strong multi-year advance. Many of the fundamental drivers that supported the bull market remain intact, even if near-term technical conditions have weakened. A correction that reaches the 10 to 15% range, or even the deeper end of Tom Lee's 15 to 20% framework, would be consistent with historical digestion phases inside larger bull markets. The practical takeaway is straightforward. Respect the weekly structure that is now in place. The series of lower highs and lower lows, the depth of this week's low relative to the past 12 weeks, and the negative weekly MACD all confirm that the summer into Q3 correction has begun on the timeframe that matters for intermediate positioning. Stay focused on the weekly chart for the primary trend message. Use shorter timeframes for entries and risk management, but do not let daily noise override the larger pattern. Opportunities will appear on both sides of the market as this process unfolds. For those with a longer horizon, the developing correction is the kind of period that has historically offered better entry points once the weekly structure begins to stabilize. That is the current read. The market has shifted into corrective mode on the weekly timeframe. The next several weeks will tell us how deep and how orderly that correction becomes. We will continue tracking the structure, the momentum signals, and the key levels as the picture evolves. Thank you for watching Dave's Market Explorer. Stay disciplined and we will see you in the next update.